In this video, we are going to discuss about fiscal policy. First of all, we have to understand what is fiscal policy. Fiscal policy is the means by which a government adjusts its spending level and tax rate to monitor and influence nation's income. In proper wording, government decisions on spending and taxation that are intended to improve or maintain the economy. Federal budget. A federal budget is a certain amount of money which a government is going to spend to generate a revenue. For every fiscal year, government has to make a new budget. Fiscal year is a 12-month period, not necessarily from January to December. A government may add to it through supplementary budgets or mini budgets from time to time, according to the need. The change in government spending and taxation had hug impact on economy output. Government can adopt two types of fiscal policies: expansionary policies and contractionary policies. Expansionary policies that try to increase the output of the economy. Contractionary policies that try to decrease the output of the economy. An economy producing at full employment is not in need of any fiscal policy. However, an economy in recession could benefit from expansionary demand side policy. If aggregate demand is too high and has high inflation, an economy could be benefited from contractionary demand side policy that reduce aggregate demand. As we know that major source of revenue for a government is a tax collection. The source of revenue for a government other than tax collection are sales of goods and services, sales of government property, the privatization of state-owned enterprises. Direct taxes are the taxes on income earned by household and firms. All the individuals pay same percentage no matter what their income is. Taxes on consumption are indirect. There are three types of government expenditures: current expenditures, capital expenditures, and transfer payments. Current expenditures are the expenditures which are day-to-day cost of running the government, the wages and salaries of public employees, etc. Capital expenditures are the expenditures spent by the government on infrastructure such as money spent on roads, bridges, schools, etc. A government budget is a balanced budget if its expenditure is equal to its tax revenue. A government budget is in surplus if tax collected in that year is greater than the expenditure of that year. A government budget is in deficit if the expenditure of that particular year is greater than the tax collected in the particular year. The budget deficit will add to the national debt. During a contraction or recession, there is a need of expansion of our economy. The government can do two things: decrease taxes or increase spending. By decreasing taxes, government gave more money to the people or household to spend. As a result, aggregate demand for the goods are increases. When government decreases taxes, it gives more money to people to spend. More money is equal to more demand. When demand rises, the production is also rises. More production needs more labor force to work. That creates more job opportunities. When these people get paid, they also buy and consume goods and services that increase more demand. When government increase spending, it also affects the production. Increased demand for good, more demand is equal to more production. As you know that when demand rises, the production is also rises. More production creates more job opportunities. And there is a debate that who favors which policy, decreasing taxes or increasing government spendings. The beneficiaries of tax cut are the rich peoples who get a tax cut. So it is better that government should spend to redistribute wealth to the poor rather than giving the tax cut to the rich peoples. During a period of excessive inflation, inflation means the price of goods and services are too high. To control the inflation, the government can do two things: increase taxes or decrease the government spendings. Both can affect the economy and contract the demand, aggregate demand. When government increase taxes, It means that the people have less money to spend. When people have less money, they buy less goods. This means this decreases demand. When there is a less demand, there is a low rate of goods and services. As a result, the lower inflation in the country. When government decrease the government spendings, it means that there is a less money in the economy. Less money means that the purchasing power of people is also down. So the demand for the goods are also fallen. The less demand is equal to lower inflation. Here a question arises that who favors which policy? Neither party favors contractionary policies. This is one of the problems with fiscal policy, that the government official and public never favors contractionary policy, as it increase taxes and decrease government spending. There are some problems with fiscal policy. It is unpopular to raise taxes or cut government spending, so elected officials worry about re-elections, rarely do either. If government increase taxes, they have fear to lose re-elections, as the public was not happy. And if government cuts taxes, they have less money to spend or they go into debt. The federal debt is in trillions of dollars, so the government has to borrow money by selling bonds. These bonds have to be paid back by with interest, costing the government more money. This is some sort of problems